Hi there, John Bowens again with Equity Trust Company. In this segment, we're going to be talking about compounding interest in the absence of taxation, utilizing a self-directed IRA or other retirement account. And we're going to demonstrate this to you by utilizing a real estate investment example. Let's get to the whiteboard. So let's whiteboard this, showing a case study and then applying the numbers to the compounding interest calculation using our financial calculator. By the way, if you're interested in doing some of this analysis on your own, you can go to the Equity Trust website, www.trustetc.com, and under our resource section, we have these financial calculators that you can plug and play with. So this case study is Michelle, and Michelle submitted this case study in 2019. She was applying for the 2018 Investor of the Year award that we give out every year. And Michelle gave us this transaction where she partnered 3 IRAs within her family. She had an IRA for her husband, an IRA for herself, and then her 19-year-old daughter. Now you got to make sure you do this properly, and we have another segment on partnering multiple IRAs together. But in this transaction, they had 3 IRAs all partnering on a deal to buy a property for $24,000. They bought a rental property for $24,000. At the time of buying it, it had a current value of around $40,000. So they bought it at a discount for $24,000, and the present value calculation or present value figure that I'm using is $8,000 because her daughter put in $8,000 into the deal. So it's a $24,000 property purchase, and each party, mom and dad, and then the 19-year-old daughter with her Roth IRA, each put in about $8,000 for the $24,000 purchase. So we're going to start at $8,000, and what we're going to do is we're going to make some assumptions. Okay, this is a little bit of a hypothetical example, but we're going to make some assumptions. We're going to say, okay, if she consistently makes a 19% return on investment, because right now with this rental property, as it's cash flowing, the annualized return on investment is 19%. So if we project this out over 20 years, consistently receiving a 19% return on investment, if we go over to this graph here, in her Roth IRA, she will have saved over $308,000. Now you're probably wondering at this time, okay, what's the difference between this Roth and this traditional and then this taxable savings? Well, we have our tax-free account, we have our tax-deferred account, such as a traditional IRA, and then, of course, we have our taxable savings. So what do we mean by when we say taxable savings? What we mean by that is if we buy a property, we buy an asset, and it's producing income, in a general sense, we have to pay taxes on that income. And there's different tax rates depending on the individual situation, whether it's short-term, long-term capital gains, or ordinary income taxes, and, of course, the individual themselves in what their current tax rate is. But all in, we're looking at this equation here, our future value compounding interest equation. Future value equals present value times 1 plus r to the nth power. That's the number of years. Now the one variable that we didn't factor into this equation, and most people don't factor in, is taxes. So in our compounding interest equation, we need to factor in taxes. If we factor in taxes using this particular example, and we put in 20%, so if I factor 20% into my future value calculation, that's only $156,000 because each year I'm paying taxes on a percentage of my profits. Therefore, I have less buying power for my next transaction, earning 19% year over year. In a traditional IRA, factoring in 20% upon the withdrawal, I will have $246,000, close to $247,000 because tax deferred means eventually when I take the money out, I have to pay taxes. And then again, with the Roth IRA, I have over $308,000, close to $309,000 tax-free in that Roth IRA. Now projecting Michelle's daughter's situation over 20 years, let's then project this out even further to when she's 59 and a half or older. All the money in that account after the qualified retirement age of 59 and a half can be taken out 100% tax-free, providing that she's doing everything properly. So this is a great illustration of showing you how compounding interest in the absence of taxation, whether traditional or Roth, can be a very, very powerful financial instrument. So let's move on to our next example. And this is a hypothetical example. Let's say we have someone that's interested in lending money with their self-directed IRA. So in addition to people buying rental properties or buying, repairing, and reselling properties for a profit, we also have investors that are doing private lending where their IRA will loan money. They have a promissory note and a mortgage or deed of trust secured by that property. And then their IRA is receiving interest income back into that account. So in this example, I'm going to say that our present value is $50,000. So we're starting with $50,000 in an IRA that's going to be deployed for private lending opportunities. The number of years, I'm going to go ahead and plug in 20 years again. And our return on investment, I'm going to say is 12%. All right, I'm going to say 12% return on investment over 20 years, starting with $50,000. Let's jump over to our graph. In a tax-free Roth IRA, okay, this would be our Roth IRA, or could even be a health savings account or covered education savings account. That's over $540,000 saved. So $540,000 saved. Now, if I look at the tax-deferred accounts, traditional accounts, SEP IRA, Simple IRA, that's over $432,000. So I got to pay some taxes when I take the money out. And then in my taxable account, and I used a 20% tax rate. So if I'm lending money, not using an IRA, as I'm collecting interest income, I have to pay taxes on that interest income. So let's say I do all of my lending outside of my IRAs. It's all in my taxable account. And let's say I make $100,000 in interest income and I have a 20% effective tax rate. 20% of $100,000 is $20,000. So I make $100,000 and I got to write a check for $20,000 in taxes, leaving me only $80,000. I do this in an IRA and it's all tax exempt, going directly back into the retirement plan. So again, plugging into our financial calculator here, over the 20-year period, earning a 12% consistent return on investment, I will have saved over $540,000. Again, a representation of how powerful compounding interest can be in both a tax-free and tax-deferred environment. Equity Trust Company is a passive, non-discretionary custodian. We're here to give you a lot of information and education, and I would encourage you to subscribe to our YouTube channel. For additional videos and content, we'll make sure that we provide notifications to you as a Equity Trust Company YouTube subscriber. We look forward to seeing you on the next segment.